Imagine standing on the balcony of a bustling hotel in 1929, the air thick with the frenzy of easy money, the ticker tape clattering out what everyone believed were unstoppable profits. Yet just beneath the surface, a small, quiet group of economists and financiers saw the cracks forming. A series of overlooked anomalies that collectively whispered a terrifying warning, a warning about the rampant use of debt, the collapse of guardrails, and the blind faith in a revolutionary new technology, a warning that almost no one heeded until the bottom fell out of the world. This wasn't the famous public prediction made by Roger Babson about a coming crash, which was swiftly dismissed as a momentary Babson break, but a far more insidious and subtle accumulation of economic sins. The quiet unraveling of trust that preceded the catastrophic failure of liquidity. And the truly unsettling realization is that if you listen closely to the echoes in our current economy, particularly as we look toward the potential volatility of 2026, those same subtle signals are repeating layer upon layer, creating a profound and dangerous parallel that we ignore at our peril. We live in a new Roaring Twenties, fueled by a new epoch-defining technology, artificial intelligence, just as the 1920s were fueled by radio and automotive revolutions. And in both eras, the prevailing belief is that this time is different, that the innovation is so transformative it justifies any valuation, any level of debt, and any amount of speculation. But history has a chilling way of rhyming, not necessarily repeating line for line, but certainly following the same destructive rhythm. And the warning no one talks about from 1929 is that the crash was not caused by a sudden external shock, but by a self-inflicted wound. The systemic collapse of confidence that happened when ordinary people, leveraged to the hilt by easy credit, realized the entire financial house was built on sand. And the silent, most dangerous indicators of that structural fragility are flashing bright red in the modern economy right now, setting the stage for a dramatic reckoning. The first, and perhaps most overlooked, warning of 1929 was not about stock prices, but about the rampant democratization of speculative debt, which lured everyday people into a game they could not afford to lose. Before the crash, Wall Street bankers and brokers aggressively encouraged average citizens, plumbers, teachers, secretaries, to buy stocks on margin, which meant they only had to put down a small percentage, often just 10% of the stock's price, borrowing the rest from their broker. This practice was effectively giving free rein to excessive risk, creating a mountain of debt that was highly exposed to even the smallest market correction. It felt like free money as long as the market was soaring, but it was an explosive trap waiting for the first downward movement. The parallel today is complex, but undeniably present. While the mechanics of traditional margin loans are more regulated, we have seen a massive surge in alternative forms of leveraged speculation and debt accumulation. This includes the democratization of highly volatile assets like meme stocks and crypto, often purchased on new platforms that encourage high-frequency, high-risk trading with very little friction, and crucially, the unprecedented levels of corporate and national debt. In 1929, the small-time investor was leveraged. Today, the entire system is leveraged, with corporate debt loads reaching historic highs and national debt ballooning in a way that, while seemingly sustainable in a low-rate environment, becomes a profound systemic risk when interest rates must rise. A scenario that Federal Reserve actions have already put into play, this pervasive dependency on cheap and easy money. The modern-day equivalent of that 10% margin loan means that a decline in asset values will not just hurt fortunes, but could trigger a systemic call for collateral that cascades through the entire financial ecosystem, just as margin calls did in 1929, turning a correction into a full-blown crisis. The second critical parallel, an element often overlooked in the historical narrative of the Great Crash, was the unchecked hype cycle of the era's dominant technology, which created an atmosphere of absolute, unshakable belief in new era growth. In the 1920s, the high-flying stocks were not just utilities and railroads, but companies at the forefront of transformative technologies like Radio Corporation of America, RCA, which was the NVIDIA of its day, a company whose stock price soared to unsustainable heights based purely on the promise of future earnings in an entirely new medium. Investors were told the industry was too revolutionary, too important, and too transformative to ever fail, leading to valuations detached from any measurable fundamentals. And this was the intellectual cover for the pervasive speculation. Today, the modern equivalent is the relentless, market-driving hype surrounding artificial intelligence. While the technology is undeniably transformative, the valuations of the select group of Magnificent Seven or related AI infrastructure stocks have reached ludicrous, historic highs, driven by the identical, this time is different narrative. The collective belief is that the profits derived from AI will be so vast and arrive so quickly that they justify current prices, ignoring the intense competitive risks, the immense capital expenditure required, and the uncertain regulatory landscape. And this is the core of the Babson warning from 1929. Economist Roger Babson pointed out that production and freight figures were beginning to dip, even as share prices hit new heights, signaling that the market's ascent was masking a softening underlying economy. Today, we see similar signs: extreme concentration of market gains in a handful of AI-related stocks, while broader economic indicators and small-cap stocks struggle, suggesting that the prosperity is narrow and highly speculative, resting on the shoulders of a few technological giants whose valuation could evaporate in a sudden shift of narrative or a technological disappointment. A third and deeply troubling parallel lies in the silent dismantling of investor guardrails and weakening of regulatory oversight that creates the conditions for systemic abuse. Following the 1929 crash, and subsequently the 2008 financial crisis, laws and regulations were put in place. The Glass-Steagall Act, the creation of the and various investor protection rules all designed to prevent the reckless speculation and self-dealing that characterized the 1920s. However, the modern financial landscape has seen a gradual, systematic erosion of these protections, often in the name of democratizing finance or increasing capital efficiency. The 1929 market was full of underhand banking practices and a lack of transparency. Today, we see a massive shift of risk and activity into the less regulated shadow banking system, private equity, private credit, and large hedge funds that operates with far less oversight than traditional regulated banks, creating pockets of systemic risk that are opaque to regulators. Furthermore, the push to allow ordinary investors into high-risk, less regulated private markets, often through retirement funds, mirrors the 1929 broker's pitch. The chance to get rich quick, but with fewer disclosures and far less protection when the market turns. Financial commentator Andrew Ross Sorkin, who has spent years studying the 1929 crash, points to this removal of guardrails, combined with high debt and rampant speculation, as the most worrying echo, arguing that the system is not necessarily going to crash tomorrow, but that it is being deliberately made vulnerable to a catastrophic failure once the inevitable correction begins, making the current financial system brittle and overly complex, prone to seizing up precisely when liquidity is most needed, much like the failure of correspondent banking in the early 1930s. The fourth, overlooked warning from 1929, and one that connects directly to the psychological engine of a modern crash, is the vicious cycle of information delay and panic-driven liquidity failure. On Black Thursday, October 24, 1929, the flood of sell orders was so overwhelming that the telegraphic ticker tapes, the sole source of price information for millions of investors across the country, lagged hours behind the actual trading on the floor of the New York Stock Exchange. Investors selling at a perceived price discovered minutes or hours later that the actual price they received was, which only fueled further panic and distrust, leading to even more frenzied selling. And the market seized up because buyers had no reliable way to assess value. Today, the problem is not a slow ticker tape, but the exact opposite. Algorithmic flash speed and market reflexivity. While information is instantaneous, the trading is dominated by ultra-fast algorithms that react to any signal no matter how small in milliseconds, turning a simple price dip into a hyper-accelerated crash, a phenomenon we already witnessed during the 2010 flash crash. Moreover, the prevalence of social media and news cycles means that sentiment and panic can spread globally at the speed of light, and in a heavily leveraged environment, this instant, panicky reflexivity can trigger margin calls and force selling across continents, exacerbating the problem of liquidity drying up instantly. In 1929, JP Morgan and other bankers famously tried to intervene by buying up blue-chip stocks to restore confidence, a move that only briefly worked. Today, the market is so vast and complex that only the Federal Reserve can step in as the buyer of last resort. And the very complexity of the digitally interconnected market means that when a crisis of confidence hits, the market will move violently down faster than any regulator can react, confirming The 1929 lesson that once confidence breaks, no single entity can stop the cascade. In wrapping this up, the 1929 warning no one is truly focused on is the subtle but deadly convergence of unchecked debt, speculative excess in a revolutionary tech sector, and the silent weakening of financial guardrails, a recipe for disaster that suggests 2026, or the period immediately following, could be the moment when the market's structural weaknesses are finally exposed. The history of 1929 shows us that the Great Crash was not a random act of economic violence, but the inevitable conclusion of a debt-fueled mania that was given a flimsy intellectual veneer by the promise of a new era. Today, the forces are identical. The unprecedented boom in AI stocks is the modern RCA. The global debt pile is the modern margin loan. And the deregulation of private markets is the dismantling of the old guardrails. The system may have circuit breakers, but the scale of the debt and the speed of the digital market mean that once the crisis of confidence hits, once the crowd realizes the emperor of high valuations has no clothes, the plunge will be fast and deep, likely catching ordinary investors who have been told this time is different completely off guard, just as they were almost a century ago. The real warning is that history's most terrifying financial events are always preceded by a period of incredible self-congratulatory euphoria, and the sound of the ticker tape clattering with supposed profit is often the prelude to the silence of the crash.